Hello world, welcome to Farm the Market. This is the weekly stock market recap. Let's review some of the things that I found the most interesting. VIX Futures Contango streak broken. One of the events that caught my eye the most was the fact that for the first time since January 27, 2021, the front 2 months of the VIX Futures term structure went into backwardation. This means that the front month future closed above the second month future. This is relevant because the market is pricing in more risk in the very short term. That's usually not the case. Under normal market conditions, the VIX futures curve is in Contango, meaning the futures go up in value the further you go out in time. Now, this by itself could mean nothing. For example, the last time this happened, in January, the curve switched back to Contango the next day and stayed like that for almost a year, until yesterday. But I think it's important to take notice, especially because it was a very long streak, during which the S&P 500 is up around 21%, deep buying has been king, and many market participants are being complacent. This change in the curve, in conjunction with other metrics, could be telling us something. VIX closes above 30. The mighty VIX index, also known as the Fear Index, closed the week over 30. I don't rely too much on the absolute value of the VIX. I don't find it to be that useful. I would pay more attention to the study of the VIX futures curve, for example. Having said that, I bring it up because there's a lot of talk out there about easy trades to fade the VIX whenever it breaks 30. First of all, there's no such thing as an easy trade. If you go out and blindly trade something like that, you will eventually get burned, especially if you don't manage risk. By nature, volatility tends to spike. It only takes to be caught once on the wrong side to erase many easy wins. If you are considering this type of trades, at least contemplate using variants with defined risk profiles. I would also like to emphasize that I mentioned earlier the absolute value of the VIX, and that was for a reason. When using a volatility metric, I would encourage you to approach them in a relative basis. A 30 VIX before February 2018 or March 2020 is not the same 30 VIX as today. I might dig deeper into this topic on a future video. The S&P 500 weekly expected move wasn't breached. Using round numbers, the options market was expecting the S&P 500 to move between 4,750 and 4,440 points for the week. That implied a move of about 155 points either way, and the S&P 500 didn't even come close to either edge. I bring this up for context. Even if you felt this week was awful, the actual move was short of expectations. It was mild. It was really nothing to write home about for the broad market. Of course, for particular sectors or stocks, the story might be much different. But the natural approach when talking about the broad stock market is to use the S&P 500 as the benchmark. That's always the starting point. If you're in a world of pain right now, maybe it's a good time to review your portfolio. After all, the tides are still relatively calm. What could happen if things get worse? For the next week, the options market is again expecting a move of about 155 points either way. Take that into account. Options buyers, beware. As I mentioned earlier, buy the dip has been king for a long time. It should continue to work, right? Who knows? What everyone knows is that 2020 and 2021 has been the boom time for options trading all over the world. It's the best thing ever since indoor plumbing. Options are great tools. I love them. But as any tool, it must be used properly. I bring this up because there's a lot of talk out there about buying the dip, leveraging up with options, and making big bucks. I just want to bring up the topic of volatility. Remember, options have many moving parts. If you go out and just buy call options like crazy, even if you're right about the direction of the underlying, Remember, you are paying a high volatility right now. If the price of the underlying actually goes up, the most likely scenario is the volatility will crush and your option will be severely affected by it. I cannot tell you what to do or not to do. What I will just mention is worth analyzing using spreads or other strategies that mitigate Vega exposure. Premium sellers, early Christmas? The other side of the coin would be the hype growing on premium sellers. During the week, many individual names hit IV rank levels of 100%. I would put an asterisk on those levels. As I mentioned earlier, the past 12 months have been pretty calm and steady if you put things in context. If many names are being hit hard before the broad market is really shaken, imagine what can happen if the broad market takes a dive. Things can get nasty. Again, if you are looking for premium selling opportunities, keep an eye on risk management and don't be too greedy with single options. That doesn't mean that there are no good opportunities out there. Many quality stocks that have been super overvalued for a while are going back to just, let's say, overvalued levels. During periods like this, I try to find opportunities to sell out of the money puts on stocks I would love to own at a lower price. I get paid to wait, so to speak. If the stock doesn't go down enough or goes up, so be it. I get a nice return for waiting, and I can reassess what to do depending on the new valuation. If the stock goes down enough, I'm forced to buy it at a price that I deemed reasonable in the first place, and I still get paid for waiting. I might do a detailed video about this strategy in the future, but I just thought it would be interesting to bring it up considering some premiums are getting to interesting levels. If you found this information useful and interesting, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Remember that everything presented here is for educational purposes only. Thanks for your time.